Okay, I'll get started. Thank you everyone for joining. Excited about the topic today. I'm going to try and limit this to about 25 minutes with 5 minutes of questions, but I will pay attention to the time and not get carried away because this is a topic I'm passionate about. I know other business owners are passionate about, so I will be mindful of the time. I will not be able to cover everything today, but if there's any interest, I'll be sure and have my contact information at the end, and be sure to have plenty of openings where anyone can ask questions if there's any topic that you'd like to cover. Hopefully you can see my screen now if I did the screen sharing correctly, but the topic today is value acceleration. This is meant for business owners, and it's really based on business exit planning as a whole. So I recently completed a certification, which talks a lot about this topic. I took many classes, took an exam about this topic that I'll discuss in a moment, and I've been working with other business owners on it just because it's so important. I'm going to start with a definition of business exit planning. This definition from Richard Jackham, and his definition is: an exit plan asks and answers all the business, personal, financial, legal, and tax questions involved in transitioning a privately owned business. It includes contingencies for illness, burnout, divorce, and death. Its purpose is to maximize the value of the business at the time of exit, minimize taxes, and ensure the owner is able to accomplish all of his or her personal and financial goals in the process. That's really what we're going to be focusing on today, is that last point about how do you get started maximizing your business value, and what's the best methodology? What do I take business owners through as a value advisor? So that's really what I want to discuss today. A little bit about me briefly and our firm. So my name is Eric Ashburn, for those of you that do not know me. I'm a fellow business owner along with the other partners at the firm, Diane, Cecile, and Joe. And we're a team of financial advisors that work with affluent families all over the U.S. We're based in Washington, D.C. area. 2/3 of our clients are in the DMV, but we work with clients all over. And I especially enjoy working with business owners and all of the different problem solving and planning that is involved with business owners. So my designation: certified financial planner, certified exit planning advisor. That's what we're going to be discussing today. Certified divorce financial analyst, and certified financial transitionist. So as you can probably tell from these different designations, our firm typically works with individuals and families that come to us when they're making high stakes decisions and through transitions. And then after those transitions, we continue to work with those clients on their holistic planning. But as I said, today is all about the business owners. That is a major transition that happens at some point and takes a lot of preparation. So I'm just going to be discussing that today. So here's the takeaways that I hope we're able to accomplish today. Gonna review the social and economic environment dynamics in play today, discuss common challenges and opportunities. I want to leave all the business owners with some valuable information. This is more than just informative. I want to be sure you have some takeaways. Introduce you to the value acceleration methodology that we use and that I've been trained through the Exit Planning Institute. Define the exit planning ecosystem, introduce the roles that I play, and introduce the roles of the value advisor and other members a business owner needs as part of their team. So I promise the whole presentations won't be a lot of facts, but this page and the next page, I think, has some facts that are really important, and a few stick out. So first, most baby boomers or the highest percentage of business owners are baby boomers. Let me phrase it that way, which makes sense. And it also makes sense that most believe they're going to transition out in the next 10 years. So if baby boomers are 60 to 65, 10 years puts them at 70, 75, that makes sense. However, it's important that more than 70% of businesses, all businesses in the US, private businesses that are put on the market, do not sell. And only 30% of family-owned businesses survive the second generation, 12% survive the third. So you're starting to see what the problems are. And that is, everyone thinks they're going to transition at the same time. Very few do, and not very many have a transition plan. So they do no preparation. They just think they're going to in the future, and they're not able to for whatever reason. We're going to get into some of those reasons in the following slides, but these are huge opportunities missed. If you think about it, most business owners have most of their wealth locked in their business, and only 30% are able to get that wealth out, extract that wealth. And the ones that are able to extract it, they're not being able to extract the full potential of the business. They're getting pennies on the dollar, not the full dollar. They're definitely not getting a best-in-class price, or what they believe they could be getting. So we'll get into some of those reasons, but just wanted to show you that this is the market today, and it's only going to become a bigger problem in the future when more baby boomers are selling businesses in the next 5, 10, 15 years. So this goes back to the readiness of business owners, which is a problem. So basically, 76%, as we could see on the previous slide, 76% plan to transition over the next 10 years, as I said previously. However, 99% think that they need a plan of some kind. However, 48% have done no plan at all. And this data isn't on this slide, but 66% of business owners don't know their options. So there's really a gap between what's right, everyone knows they need a plan, and what's actually being done. And that's having either very little transition plan or no plan at all. And without that preparation, especially with something as complex as a business sale, that's where the gap's coming in, of people not being able to get the value that they like, or not be able to transfer the value, which is the key of a business exit, is transferable value. So a few challenges. So what are the problems? Challenge one is business owners feeling afraid, trapped, not knowing what's next, not feeling like it's urgent because they have time, or they're misinformed. They think it's an easy process. You just pass it to the next generation and no further planning's involved, or it'll be easy to sell. These things aren't true. So uncertainty, I would say, is the biggest challenge, one of the biggest challenges that business owners face, of just not knowing how to get started, or not having any sort of methodology. This is a big one. Challenge two, why owners aren't able to get the full value, is because it's not on the business owner's own terms. 50% of exits won't be on the owner's own terms. The reasons why, we call them the 5 Ds, are death, disability, divorce, distress, disagreement with partners. This can happen. It has a real effect on businesses every day and can accelerate your timing. So maybe you have 10 years and you say, I'll start getting prepared when I have 5 more years. Well, any of these things can happen in a day. And with COVID, you could probably add another D, disease, because the amount of business owners that got sick and their businesses were never able to recover, or they couldn't go back to work. So by planning earlier, you are able to protect against these uncertainties that no one's expecting, but the numbers are 50% of exits won't be on the owner's terms. I think that's an important takeaway from today. The third challenge is owners are leaving cash on the table because they're focused on income generation, not enough on enterprise value. What I mean by that is the most important thing isn't just to get as much income as possible. It's to have as much value in the business as possible, because having a very valuable business will mean two things. It will mean having the income because you have efficiencies, you have the right people, you have everything working inside of a valuable business. And it also is transferable, which is, as I said, the key of being able to sell your business or take advantage of any exit plan in the future. So how do we resolve those challenges? That is the next natural question, and it really means a change in mindset. So the first paradigm is to focus on holistic planning. I'm going to get a little bit more into these bullet points in the following slides, but this is one thing that sticks out, and it's 70% of owners regret selling 1 year after the sell. So we already went over only 30% of businesses sell. Of that 30%, 70% regret it a year later. And the reason that there is the regret is because you're not fully prepared with what the transition will mean. In other words, maybe you just plan to sell your business and you just say, I'm going to play golf every day. Maybe this is a bad example because that doesn't sound too bad, but you say you're just going to play golf every day, don't really have a plan. Well, after 6 months, that's going to get old. If you're selling your business at 50, you're planning to do that for 40 years. It's not sustainable. So you really have to be sure you have a plan for what's the money going to go towards, what's it funding, what are your goals, what are you going to do with your time. By focusing on holistic planning, you can help take away that potential regret that could come later with selling a business. The second paradigm shift is thinking about exit planning as a business strategy. You're business owners, you're familiar with business strategy. You wouldn't ignore any other business strategy or something that affects your day-to-day business. So exit planning should be treated the same way. That means really focusing on the intangible capitals. Roughly, this depends on the business, on the industry, but there's an estimate of 80% of your business's value come from the intangible capitals. Unless you're a high inventory business, something like that, most of the value is in the customer and the structure and the social and the human. We'll get into these in just a minute, but that's really what's important. Who's in your business, what's in your business, and is it transferable to a future buyer? Making exit planning a business strategy means make the common but unintentional behavior very intentional and deliberate. It's something you'll have to continuously work on. It doesn't get solved overnight, but by having a plan in place, revisiting it, having a process, it becomes much easier over time. And when I say all this, it sounds like another job, more time, which I know that's the most precious commodity for business owners is time. So I'm not saying it's something you have to spend 40 hours a week on. It takes some upfront work, which your team helps you with. Me as a value advisor, the rest of the team. But it's a little bit of time at the beginning, and then it gets easier. and then it transforms your business, and then it adds value to your business. So you're investing a little bit of time up front, but it will pay off and then some over the future. The third shift is adopting a common framework. So I know I've mentioned this several times. I'm a big believer in SEPA and the Exit Planning Institute. It's one of the most well-known designations as an advisor to help business owners. But what they are very, very big on, and what they have taught me, is the methodology. So using a proven process that focuses on growth and aligning, as I said, the business, your personal, your financial goals, so that it's all working together and really maximizing the value of your business. A lot of questions I get asked is, what's the minimum amount of time to start the methodology and really grow the value of your business? So again, it probably varies business to business and where you are and how much work needs to be done and what industry. But the rule of thumb that we like to use is you should really have at least 3 years is key before you're planning to sell or take action. Because if a business usually takes, I don't know, a year to sell, I would say at a minimum, we need to spend 1 or 2 years de-risking the business. So that will increase the value, because that's the first step. Where your risk, how do we de-risk? How do we protect what you have? And then as you have more time, we focus on growth. Where can we make improvements? Where can we take calculated risk and really increase the value? That isn't to say if you only have 1 year, you should just give up. If you only have 2 years, you shouldn't look at this. It's still absolutely worth looking at where you could fall short and preparing with the time you do have. And if you have 10, 15 years, even better. We look at the methodology, we look at the process, we make changes now that will really grow the business 5, 10, 15 years down the line, and just revisit it as needed along with the rest of your plan. Okay, so now what is the methodology? So I know this is a busy page. I'm going to talk about it a little bit more in a minute and break it down. But basically the steps, think of them as 3 gates. First, we discover. And what that means is digging into the business, into the financials, seeing where your gaps are, and prioritizing an action plan. What are the areas based on the analysis that we've done that we need to address first? Then once we have an action plan, we start to prepare. And that means, again, merging the personal and business, all of those goals together, figuring out where we can de-risk the business, and planning from there. Once we've done the planning and we've worked on de-risking the business, we've looked at opportunities where to grow the business, we constantly are faced with this decision. Okay, so now that we're at a comfortable place, we know our value compared to its potential, we know your business value compared to the rest of the market, is now a good time to exit? The answer, if the answer is no, it's nowhere close, that's fine. Then we keep going and we look again and see where we can add value, what we need to do, what should be prioritized. And we're constantly going back through this, not in the same level of detail as the first time. You don't need to do as full of an analysis as is needed the first time, but you're going through this process and revisiting the question. Should I keep it? Should I sell it? What are my options? What's the market right now? And if an opportunity comes about, this is something you've already thought about. Are you going to grow or are you going to exit? So it's something that you'll have a very clear answer and be able to make the best decisions possible. So as I said, I'm going to revisit this process again in just a second, but first I wanted to go over some of the concepts that I've been taught through the Exit Planning Institute, and I think that will be valuable for business owners. For the first major concept from the Exit Planning Institute is a successful exit strategy has 3 legs. So I've kind of already mentioned these legs, but all have to be present and have to be in alignment. So this includes personal planning. What do you want to do in the next phase? Personal financial planning. It's merging the personal, the financial, and the business. And by doing that, the regret post-selling that many have, you are more likely not to have. Most of that comes from a lack of personal planning, but it could be any of the 3 stools that are lacking, which is what causes the regret, which causes the lack of purpose and confusion and not knowing what to do. Most of the business owners we've spoken to that didn't have a successful transition came to us after the fact. They got bored. They didn't know what else to do with life. Especially if they were working 40, 50, 60 hours a week. They thought they would just retire, buy a big house and figure it out, but it rarely works that way. So we spend time definitely focusing, intertwining all areas of the stool. So this is the 5 stages that we go through as part of that methodology. So I touched a little bit on this before, but this is just a different visual. First, we're identifying where your business is at today, what we believe your business is worth. How does that compare to what it could be worth? So that is the value gap. And I think that's really important to see how far off you are, taking a real look at a realistic look from a buyer's perspective where you are today. Once we find that out, we work to protect what you have. Be sure any risk we're going to take on, you're protected first and foremost, because those 5 Ds that I mentioned earlier can happen at any time. So we need to be sure we're protecting what you have and everything that you've built with your business. From there, we build. We see where can we grow, what makes sense. It does involve, it is a more risky stage. It could involve taking on debt, taking on people, taking on leverage. But since you've already protected, done the contingency planning, the risk analysis, updating buy-sell agreements, you're more in a better position to be taking on this risk. Once it's been built, you just work on harvesting and managing what you have, keeping it at that high functioning, high value level so that you're ready for the opportunities that come about. And as you're growing to each phase, the business value is growing, the income is growing because you're building, you're growing. So it's just continuously trending up. So this, I think, is a good visual just to show the steps. This is what I mentioned earlier with 80% of a business's value being the intangible assets. So they're pretty self-explanatory, but human capital basically is the strength of your people, their experience, their skills, their cross-training, their product knowledge, your management team. It is the structural, which is the most robust. It's your processes, your documents, your IT, your inventory, everything that's functioning inside of the business. Your customer, the most frequent risk we see here is concentration. You have too much in one or few customers, or not enough customers, or your business is too entangled to you personally as the owner, which just lowers your value because it's less transferable when the customer only wants to work with you. or only wants to work with certain individuals. I know that feels good, but again, this exit planning, this process is about maximizing the business value, and that will be what's most beneficial to you as an owner. Lastly, the social is the culture and the people that exist inside. It's the hardest to rate, in our opinion, because it varies so much on the business and the industry. For example, Google, I know, has the policy you can wear jeans to work, very laid back. That doesn't really work at a bank, or other or similar, more traditional organizations. So it takes some work to go through, but I would say this is the last step, the social. And part of the process, the first part of the process, when we're determining your business value, we are looking in depth at all of these areas. We ask, I want to say it's 200 questions we're rating in 200 different areas across 25 categories that fit into each of these areas. From there, we've seen a very accurate business value and very accurate what's most important to work on specifically. And from there, we're able to set goals, understand how transferable the business is, and not necessarily exiting today, but you're ready when the time does come. You know the weak parts of the business, and it helps with prioritization. And very importantly, as I said before, it shows you where the gaps are. How much could you sell your business for if you waited and worked on these flaws or these issues? And how much do you need to sell the business for to have the life that you need in retirement for you and your family? The last concept from the Exit Planning Institute is just relentless execution. I know this all sounds good, but it's about executing on the plan. So as a business owner, having the vision, what you want, making sure all of these ideas are aligned, having accountability, following through. That's what we're here for, to help as accountability buddies, and having rhythm, making sure is, again, you're doing all this a little bit at a time and staying consistent, taking it off in bite-sized chunks instead of waking up, deciding you're going to sell, and being very surprised what you're able to get and how a buyer sees your business. So I'm just going to spend another minute, I know I'm running low on time, talking about the team that's involved. So in this first area, as I said, the discover phase, where you're figuring out what your business is worth. There's several team members involved: the CPA, attorney, financial planner, insurance agent, value advisor. I probably would fit in all three of these: financial planner, and we can provide insurance as needed. We have experts in this area, and value advisor, that is the SEPA designation. And we would work with an attorney and CPA just to make sure everything's aligned in this discover phase. The prepare stage is where you're digging deep. You're taking action on the estate, on the tax planning, on the buy-sell agreements. You're taking action on the insurance, on the contingency planning, needs versus wants, what you want after planning. You can see this is all different elements of preparing. So you're not exiting yet. You're just taking care of all of these areas that protect you and increase the value of your business. And again, these are the different areas. I don't need to get into detail. And then when you ultimately decide, it depends what you've done in the discover and prepare phase, but this is where, as an owner, you're much more educated. You know all the different options. You know who you need to go to for the different options. For example, if you're doing a family succession, you've done all that prep work. You don't need some of these other areas. but at this point as an owner, you know your options and you have a plan in place. Okay, I did pretty good on time. Ran a few minutes over, but as promised, I just wanted to share my information. Obviously wasn't able to cover all the material today, and I hope this wasn't too much of a fire hose approach of information and you were able to have some good takeaways. As a next step, feel free to reach out to me. My email is my name, Eric Ashburn at argentbridge.com, or visit our website, argentbridgeadvisors.com. Be happy to have a complimentary 20-minute consultation. Just talk more about your needs, what you specifically need help with, what phase you are, and how we may be able to help. But I think that this is a great next step, and I hope at the very least this was informative and gets some action going where needed. So with that, I'll open it. I know, as I said, I'm over time. I'll open it just a couple minutes in case anybody has any questions specifically in the chat. Feel free to enter them in and I'll answer them. And if you have more specific questions or it's a more nuanced question, again, feel free to email or call me and I can answer it there. Okay, either I gave way too much information and everyone is overwhelmed, or I covered everything and there's no questions. But in either case, I will leave it at that. And again, anyone can contact me that would like, and we can discuss in further detail. But I truly appreciate everyone that was able to join today and truly hope that this was helpful for you. If you'd like the slides, just contact us, be happy to send them. And I look forward to helping any listeners on the call, business owners, with maximizing their business value and figuring out what step they're on and what's most important as a next step. Thanks again, everyone.